minutes.
But let's kickstart trading now with a corporate. We've got Newgen Software joining in, came out with their numbers yesterday during market hours. Good quarter for Newgen Software. Now, December quarter is usually a seasonally strong quarter, and this time we've seen a revenue growth of 26% on a year-on-year basis. Margins have contracted, though, on a year-on-year basis. The stock currently is up close to just about 1%. In the last 3 months, it's gained close to about 10%. We're now joined by the management of the company to discuss it. We have with us the CEO, Virender Jeet, on the show now. Mr. Jeet, morning, and thanks so much for joining in. This is Rima here. 9-month FY23 revenue growth of 22%. Is there scope for you to upgrade your FY23 top-line guidance of 22%? And where do you think you will end FY23 with in terms of margins?
Good morning, and thank you for having me on the show. You're right. I think so far, for first 9 months, we had a broad-based growth across all the markets. And Q3 was strong with almost 26% growth for us. And you're right, seasonally, Q3 and Q4 are stronger quarters for us on the revenue side. And we expect Q4 to also be a strong quarter for us. And since they were larger in the revenue, they become the primary contributing factors to the margin. So it will expand from here. And, on the long term, the margin, our company generates, very high gross margins. We are in the software license business. And the net margins are completely a function of our investments in R&D and sales and marketing. We think we can sustain a margin of 17 to 18% net margin and around 20 to 23%, total EBITDA margins for the year as well as for the next year.
And for FY23, considering that Q4 is very strong and in the first 9 months, you've already done a 22% top-line growth. What could be the revenue growth for the full year? Can we touch 25%, say?
There's no reason we should not be able to, make it better than that. But whether it's going to be a 23, 24, or 25% would depend on really the outcome of how the deals flow. And, there's a, while it's seasonality, but we are basing our results also on very strong performances on Q2 and Q3. So we'll have to factor in that. But we are very sure that, our growth rates can exceed the growth rates which are right now up to 9 months.
Okay, so growth rates can exceed what you've seen in the 9 months of this year. But can you give us some insights, Mr. Jeet, on how the situation is from the client's front? Are you seeing any slowdown in terms of client spending, any delays in decision-making, any stress from the client's end that could perhaps impact your business in this year?
Not really. In fact, I think contrary to the kind of message around recession, I think we have seen contrary to the markets, especially in India, Middle East, APAC, which have been our traditionally strong markets. We are seeing strong traction from all our clients across all segments, predominantly in financial services, insurance, government. They've been very strong for us. We are, our revenue share from markets like US and Europe is just below 30%. So we are not really very strong in Europe. So our presence, we have just started operations out there. But in US, some of the larger clients are having concerns around what's going to unfold around next 6 months, 7 months. And some of those decisions are being slightly held back. But in most of our segments, we don't see any concerns right now. And on the back of our business being strongly built in emerging markets, we are quite positive that we'll continue the growth momentum.
All right, got that. Mr. Jeet, good morning and thanks for joining us. I want to ask you specifically on the India business because over there you've seen quite a jump come through, around 28% in terms of a revenue growth sequentially and also around 40% versus last year. Can you tell us what led to this sharp jump in the India business?
India, I think this business, if you look track over last 8-9 years, it has been always like that. For a few years, it has a very strong performance and then it's become slightly, muted. And if you look at during the COVID era, India business was very slow for us. And in fact, most of the government as well as financial sectors were not performing at the same pace. But now that there is a kind of a demand which has not been serviced. But having said that, what is happening in segments like financial services where digital is leading the way, a lot of transformation projects are happening. And we have, one of the largest shares in banking and insurance, and we almost have, 90% of the market share in terms of presence in these accounts. Now, as these accounts are getting into more and more digital initiatives, we are finding more and more traction out there. I think that momentum can continue for next 2-3 years. And I think we're very positive about this market. But then, there is a government was pretty slow for last 2-3 years for us. Now it is picking up this year. The government has provided for us. That adds. Insurance, we are seeing, there's an activity that in next 2-3 years there's going to be a lot of growth and momentum happening in insurance. So overall, we're very quite positive about the Indian market.
EMEA has seen a revenue decline of 4.5% on a quarter-on-quarter basis. I know, Virender, you prefer looking at your numbers on a year-on-year basis, but if you could just tell us why it's seen a drop-off on a quarter-on-quarter basis, and even the APAC profitability. The APAC profitability too is down quarter-on-quarter and on a year-on-year basis. If you could just explain what happened.
So I think you can check the EMEA is predominantly Middle East Africa for us and very little of Europe. We have grown roughly around 26% in that region in Q3. So I don't think there is any decline in any revenue. None of the regions has declined on revenue. I think the lowest is US for us, which has grown at 13%. And all regions have grown higher than that. Also on the 9-month basis, they're about 27% growth. So you could probably check that number. Or on the APAC, on the margin side, right, what has happened, I think we have invested in subsidiary in Australia. And I think right now that subsidiary is in stages of formation of business, and so there is a lot of costs, but not much of revenue has come in from that subsidiary. So those costs have got added to the APAC region, which traditionally were not the costs. So on the that's why you will see there is slightly amount of margin decline. But we are very hopeful. What has happened? We have already booked a lot of businesses in Australia, and I think the revenue of those businesses will start flowing from next year. So the margins will again get restored back.
Okay. You said US revenue growth is the slowest, right? In all the regions at just about 13%. Any particular reason, any ramp down in large clients or projects?
Not really. I think we are on our own trying to reset the business model of the US. So we were pursuing kind of businesses which were giving us traction, but we didn't find them really, aligning with our long-term objective of the business in terms of growing at higher rates. So we are pivoting out there and slightly redefining the business strategy. And, we are trying to take a few quarters to make sure that it gets established. And after that, we should be very, comfortable of. In fact, we are pushing US to be the primary growth driver over next 4-5 months.
Okay, Mr. Jeet, we leave it at that. Thanks a lot for joining in. That's Newgen Software. By the way, the market is picking